Welcome to DeFi Crypto Today. Our topic today is crypto tax planning, part 2. Last time we talked a little bit about tax planning around Halloween because a lot of people think it's scary. But we're going to see a lot of cool things that can be done to plan your taxes, okay, and try to reduce them if possible. All right, so I wanted to show you a couple memes that express very well my philosophy behind this. First one is, got Buzz Aldrich here, Buzz Lightyear, saying, don't just file your tax, plan your tax. Okay, don't let it happen like it's an accident, okay? Rich people don't have tax accidents. Okay, they pay very good tax advisors to help them plan their taxes ahead. Yeah, if you've got millions of dollars in crypto, okay, probably a good idea to get some very good fiscal advice and accounting advice, okay, from professionals. Okay, they can probably help you out. So plan. And if you have a much smaller portfolio, well, I'm going to give you some ideas, but you still should check with your accountant and tax advisors in your country to figure out if you can take advantage of the ideas that I'm going to give you today. Now, another idea that I like a lot is this one. You don't pay income tax if you don't have income. Now, some people think it's a joke, okay, and maybe the guy who made this meme thought it was a joke. But when it comes to taxes, that's no joke. That's tax planning, okay? There's a difference between having cash and having income. For tax purposes, they're completely different things. When you have income, that's taxable. You can have a ton of cash in your pocket and that's not taxable. Especially like we saw in my 5-part series now, Time to Be Your Own Bank, that you can have an asset, borrow against it to do all kinds of fun things. One of the fun things is tax planning. If you do it like that, instead of selling your asset to get some cash, it's tax-free. Okay, a loan is not a taxable event. So remember that, okay? And we're going to talk about this today a little bit. Now, to make sure that you understand that what I'm saying is real, Forbes magazine had this article on how the richest people can access billions of dollars without selling their stocks. And you have two of the richest men in the world that are using this extensively, okay? We talked a little bit about Elon Musk and his tax strategies before. Although recently he had to pay a lot of taxes, but he planned this, okay, with, like he was getting some options that were vesting, so he had to pay taxes on those options, okay? The tax law says when options vest, you have to pay taxes on them. So what he did is that he sold some Tesla shares to pay those taxes. And at the same time, a lot of people were complaining, well, you're the richest man in the world, you're not paying enough taxes. So he said, okay, fine, I'm going to pay the biggest tax bill you've ever saw. So I think he's going to have to pay something like $12 billion in taxes. I mean, it's like, that's more money than the gross national product of Nicaragua. Just to give you an idea, okay? So he's going to pay that in taxes. That's more than the whole economy of the whole country. But, I mean, he can afford it. He's worth something like $300 billion, so whatever. So this article, I'm going to show you some highlights here that are very, very interesting. It says here, this is in the US, obviously. So many of the country's richest people, including Elon Musk and Larry Ellison, borrow against their stock while avoiding capital gains tax. And it's not illegal, it's absolutely 100% legal. The tax law is designed to allow for this. They're not doing anything bad. They're just using the tax code to their advantage. And what we're going to see today is how you can do that too. It says, when the world's richest man wants cash, he can simply borrow money by putting up or pledging some of his Tesla shares as collateral for lines of credit, instead of selling shares and paying capital gains tax. These pledged shares serve as an evergreen credit facility, giving Musk access to cash when he needs it. So you see the advantage here. Elon Musk holds a very large number of shares of Tesla, something like 22-25% of the total shares, okay? And there's a huge value in there that he can use as collateral for lines of credit. And when he needs money for anything, he can take money out of those lines of credit and pay for whatever. It could be for other investments in his other businesses. It could be for personal expenses. It could be for paying school for his children, whatever. Okay? Buying a burger at McDonald's, who knows, buying the whole McDonald's, whatever he wants. Okay? He can do that using the line of credit that's backed by his Tesla shares. Now just put that in your mind that instead of Tesla shares, maybe you could do that with your crypto assets. Elon Musk is not alone. There are at least 32 billionaires identified by Forbes that are doing the same thing. That's what it says here. Okay. For instance, they talk about Larry Ellison, the chairman of Oracle, Walmart guy Jim Walton, and another famous guy, Steven Schwartzman. Okay, those are among the 3 richest ones that are doing this strategy. They pledge their shares and they borrow against them. There are at least 5% of the shareholders are pledging shares across multiple companies on the New York Stock Exchange and NASDAQ. Okay, and there's at least $427 million that are used like that, and the pledged shares are worth about 239 billion. So it's a very common practice. And why are they doing this? Because at the current interest rates, the interest rates are super low right now, and the tax rates are quite high. So it's more economical to borrow than to pay taxes. If the tax rates were lower and the interest rates were much higher, they probably would do the opposite. They would sell their shares because it would make more sense than paying very high interest. So if interest rates start going up quite a bit, they might start selling shares instead if it becomes cheaper to pay taxes. Okay? So they're taking advantage of the situation and the tax code. Now, for those that are curious, if you go to Forbes magazine, you have a long list of people, of millionaires and billionaires that are doing this. Okay? So you can read that on your own. All right. So let's go to our presentation. This is very important. Don't create taxable income if you don't have to. A lot of people, I don't know why, they buy an asset and they want to sell it. They buy Bitcoin. Okay? Bitcoin went up, I don't know, 10%. Oh, I'm going to sell it. Okay. You created a taxable event. Okay? You have a capital gain that you realize if Bitcoin went up. You're going to have to pay taxes on that. You really need to sell your Bitcoin? Probably not. Same thing with memos, you know, like wMEMO from Wonderland that we talk about on so many of my videos. A lot of people, for some reason, they say, okay, I'm going to stake it on Wonderland for a while, and then I'm going to sell it. Okay. Be ready for a big tax bill. There are ways to reduce your tax bill and not lose value. Okay? And that's what we're going to talk about today. All right. So before we go further, big fat warning here. I'm not a tax advisor. I'm not an accountant. I'm not a financial advisor. I'm not certified for anything, anywhere, on any galaxy. Okay? In any time zone, anywhere. Okay? So you need to consult certified advisors in your own country. Tax laws change from one jurisdiction to another, and I have no idea what the tax laws are in your own country. No clue. So this presentation is for your entertainment and information purposes only. What I'm talking about is rules that apply in general with regards to taxes. But in your country, they might say, we don't care about this, we care about that, we do it like this, we don't do it like that, and whatnot. Okay? And that's why you need to consult like certified accountants and tax specialists in your own country to know how to deal with taxes, okay? And how you need to report it. Do you need to write down every single little transaction that you make? How do you report that? How do you give the information to your accountant? Don't ask me. I don't know. It's done in your country. I talk to my accountant's saying, do this. I do this, that's it. She deals with the rest. I don't care. Okay? So, all right. Next, what is a taxable event? There are things that happen in life that are taxable events, and there are things that are not. And we need to find out which ones are which. So, in general, there are two main kinds of taxable events: capital gains or losses, which means you're selling an asset and maybe you make a gain or maybe you make a loss. If you make a loss, you can deduct it against your taxes somewhere, either against other capital gains or depends on your country. The rules vary different from country to country, but typically you can claim this loss somewhere. So check with your accountant on how you can do that. Okay, that will reduce your tax bill. Same thing here. Another taxable event is getting income or incurring an expense. The income will raise your taxes. The expense can be deducted against your income and will reduce your taxes. So, for instance, when you earn an asset, so you're earning an interest. Okay, you're earning LP swap fees on. Okay, so you can earn income, and sometimes you have expenses also, and typically you can deduct your expenses against your income to reduce your tax bill. So an example of income is earning an asset. So you can be earning interest. You can be earning rewards, rebases, or whatever you want to call them, or swap fees if you're using a liquidity pool. All right, so here's a very important tax secret that you need to remember. Here's very important tax secrets that you need to remember. Tax laws are written by rich people to help them get richer. Okay? In most countries, that's what it is. Rich people get in power in the country and they make laws for themselves so that they can. All right, here's some important tax secrets that you really need to know. Tax laws are written by rich people to help them get richer. Rich people get in power, they make themselves laws for their own, okay? They make the laws to make themselves richer, okay? And you can take advantage of that, okay, to make yourself richer as well. So learn how to use your tax laws in your country to your advantage, okay? Taxation doesn't have to be a burden. It's designed to look like one for salaried people, while people that are super rich don't earn salaries because salaries are taxable income, okay? And they design the laws so that they can enrich themselves. And once you understand that, you can take advantage of the laws that they design for themselves and make yourself richer as well. All right? Okay. So let's have a look at examples of capital gains and losses that are taxable events for cryptocurrencies. Okay? So let's say you're selling your cryptocurrencies for fiat. Fiat is US dollars, British pound, Japanese yen, whatever. So if you have, let's say, Bitcoin, you sell it for cash, that's a taxable event. If you made a profit on selling your Bitcoin for cash, you're going to pay taxes on that. If you had a loss, you can deduct that loss against your taxes. Using cryptocurrencies to purchase goods and services. Okay, nowadays, there are many websites and many people that offer services and they say, I want to be paid in crypto. So if you send them crypto for a service or product, okay, that's a taxable event because maybe you made a profit on your crypto and you need to record that, and that would be taxable. If you made a loss, again, that can be deducted. Right now, one thing that's very popular, there's some credit cards that are backed by crypto, okay, and they give you all kinds of advantages and whatnot. So every time you use them to buy something, that's a taxable event, okay, so keep your receipts because you're going to need them for your accountant, all right? All right, now if you trade or swap one crypto asset for another, either on an exchange or directly peer-to-peer with someone, that's also a taxable event. So let's say you go to Pancake Swap and you take your cake and you swap it for USDT, that's a taxable event. If you made a profit selling your cake or a loss selling your cake tokens, okay, that influences your taxes, okay? Same thing, if you have a time token and you stake them and they become MEMO tokens, technically you're swapping a time token for a MEMO token. But, so technically that would be a taxable event, although there's probably not a long time between the time you bought the time token and between the time you staked it, so there's probably not a big price difference. So if there's no price difference, the taxable event is not going to be important. But it's still a taxable event. Same thing, if you take your memo and you wrap it into wrap-MEMO, that's a taxable event because you're swapping memos for wrap-MEMOs. Okay, and for those that don't understand what I just said, that's in the Time to Be Your Own Bank series. 5 videos, the links are below. Okay, you can watch about that and understand what I'm talking about. We're going to see wrap tokens a little bit today, not much, but we're going to see that. All right. Now, these are examples of income and expense. I'm going to see expenses as well that are taxable events. So you're receiving cryptocurrency from an airdrop. That happens. That's taxable event. Typically, that would be an income. So you'd have to pay taxes on that. Any crypto interest earnings from decentralized finance or centralized, that should be or, not rule, or centralized finance. So DeFi would be you deposit tokens on, let's say, Trader Joe, on a farm on Trader Joe, and you're earning, you know, yield there, an APR or an APY, whatever. Same thing if you stake your memo on Wonderland, you're going to earn rebases. That's considered an interest, and you're going to have to pay taxes on that as well. Centralized exchange, well, for instance, Binance offers several projects where you can deposit tokens and earn interest. That's all taxable events. Crypto mining income from block rewards and transaction fees. So let's say you have a you're mining Bitcoin in your basement. You got like a supercomputer mining Bitcoin. It's generating income. That's taxable. Crypto earned from liquidity pools and staking. Well, we talk about staking at Wonderland, so that's it. And liquidity pools, so you deposit on Trader Joe, Pancake, Swap, Uniswap, whatever. As long as there's a pool and you're earning something, yep, that's taxable. Receiving cryptocurrency as a means of payment for carrying out work, including bug bounties. So you're selling your time, a service, a product for cryptocurrency, you have to declare that. That's a taxable income. You're a white hacker and you find bugs on protocols and they give you a bug bounty, that's taxable. That's income as well. All right. Next page, where are we? So here are examples of expenses that are taxable events. Taxable events can mean you pay, they increase your taxes or lower your taxes, okay? They're just events, okay? So all these could be deducted from your taxes, from your income, and reduce your taxes. So gas fees. So let's say you're on Ethereum and you just paid $500 of gas fees. Yeah, that's the tax deductible. You're paying deposit fees on a vault. We saw that on vaults like Morpheus and I forget there were several other vaults on Phantom where you had to deposit to pay a 2% or 2.4% deposit fee. That's deductible. Paying swapping fees on DeFi and CeFi exchanges. If you read the small print, every time you make a swap, they deduct a fee. That's also an expense. That's a taxable event. Paying bridging fees. So you're bridging funds from, let's say, Ethereum to Avalanche, or from Avalanche to Polygon, or whatever. The bridge typically charges you a fee. Okay? Can be a few dollars each time you bridge. That's deductible. Paying transaction fees when trading on CeFi. So CeFi is like Binance, let's say, and you do, let's say you're a day trader and you're doing a ton of transactions, okay? Typically, they're going to charge you a certain fee per transactions if you buy and sell. Paying interest on a crypto loan. So you're an abracadabra and you took out a loan, okay, against your collateral. Well, you have to pay interest when you take out your position, okay? When you take your collateral out, they want you to pay your loan back, okay? At that point, you have to pay interest. There's also a borrowing fee on most exchanges, like Abracadabra, and a liquidation fee if you get liquidated. So all these fees, okay, can be used, okay, to reduce your income and reduce your tax. These are not taxable events. They're not that many, but they're very important. Buying crypto with fiat. You're buying Bitcoin, okay? You took your US dollars, you deposited them on Binance or Coinbase or whatever, and you're buying crypto with it. You're buying Bitcoin, Ethereum, whatever. That's not taxable. There's nothing... No profit was created by doing this. Hodling your crypto or holding your crypto. So you got Bitcoin, it's sitting in your wallet and you keep it there for years and years and years and years and it grows up in value, but you never sell it. No tax. There's no taxable event there. You're just holding it. Transferring crypto between your own wallet. So let's say you have several wallets and you're sending money, let's say, from your Binance wallet to your MetaMask wallet. It's not a taxable event. You're not generating income by doing that, okay? There's going to be some fees taken for the transfer because it's kind of bridging. So those fees would be deductible. They're similar to the fees that we saw earlier. But other than that, it's not a taxable event. And borrowing against your crypto, that's my favorite one. When you take out a loan against crypto or any asset for that matter, against your house, against your car, whatever, or let's say you go to a pawn shop, okay, and you got some gold jewelry and you want to get cash out of that, or you got a Rolex and you want to pledge it. Getting cash out of your assets through a loan is not a taxable event. Let's review very quickly the time to be your own bank strategy. So for those that are not aware of this, there are 5 videos explaining that. The links are below, okay, in the description. So highly recommend you have a look at those videos because they really explain this strategy in great detail. We have assets that we don't want to sell because we don't want to incur taxable events. We deposit the assets to earn some yield. We wrap them. So once they're wrapped, the yield is not a taxable event also. There are many layers to my strategies, okay? In Time to Be Your Own Bank, I don't talk too much about taxes, okay? I just want to show you the convenience of being able to have your asset and keep it while it's growing in value, and to be able to borrow against it, and then you can take that loan and reinvest it to make even more money. But here I'm showing you the other aspect, which is by using this strategy, you reduce your taxable events. Because a lot of people would say, okay, I've got like, let's say you have a lot of Bitcoin and you got, let's say, $100,000 of Bitcoin. And you say, my Bitcoin is doing so well. I don't want to sell it, but I'd like to buy some Wonderland Time tokens and earn like 80,000% APY right now. That'd be nice. So what can you do, right? Typically, most people who don't know about this strategy say, well, I'm going to sell some of my Bitcoin and then I'm going to buy the time token and stake it. Yeah, you do that and you incur taxes if you made a profit on your Bitcoin that you're selling. Now you don't have to. You take your Bitcoin or your whatever asset you've got, you deposit it somewhere to earn interest, you wrap the asset, you deposit it and use it as collateral. Then you borrow stable coins against this asset and you can use it for whatever you want, like buying more assets and making even more money. And keep on looping like this as long as it's profitable to loop. Now, we're going to review again the example that we use all the time. We have time tokens that earn no yield. We stake them so that they earn some yield. They become MEMOs. We wrap the MEMOs so that we can deposit them on Abracadabra. Now, we don't want to sell our time to buy other things, because we know that when we deposit them as stake them, we're going to earn very, very high APY. Now, the problem with earning a very high APY like this is that that APY becomes taxable. But if you wrap it, it's not taxable anymore. Why? Because the rebases grow within the wrap token. Okay, it's like it becomes a capital gain instead of an income. And it's an unrealized capital gain. So until you sell your wMEMO, there's no tax. It's not a taxable event. If you just hold MEMOs and you stake them on Wonderland and you get your rebases every 8 hours, well, every 8 hours you have a taxable event, okay, because you're earning interest every 8 hours. So if you leave it like that for a long time, you're going to have a lot of taxes to pay on all those rebases that have been accumulating. If you want to avoid paying taxes on those rebases, well, you should consider using wMEMOs. Because you're not losing any rebases with your wMEMOs, you're earning the same rebases, but they're within the token. They're within the token. And let's say you're supposed to earn, let's say, $100 on your MEMOs. Well, your wMEMO is going to gain $100 also, okay? And let's say it's supposed to earn $100 every day. Okay, so today it's going to earn 100, tomorrow it's going to earn another 100, another 100, another every day like that. But it's going to grow faster than that at some point because it's compounded. But just for simplicity's sake, let's say it's 100. Okay, so after 10 days, you would gain at least 1,000 on that token, and it's all capital gain. Unrealized capital gain, so not taxable. It's only when you realize it. Realizing it means you're selling it. You're taking your wMEMO and you're selling it for another token. For instance, a lot of people ask me this question, and you have to get this very clear in your head. If you unwrap your wMEMO, now you're going to have a big pile of MEMOs, right? Because you accumulated rebases, right? So let's say you started with, let's say, one MEMO. And after, let's say, I don't know, 6 months, now you have 15, the value of 15 MEMOs inside the wMEMO. So when you unwrap it, now you have 15 MEMOs, right? Well, you're going to have to pay tax on the 14 MEMOs that you gain there. So why not keep it wrapped and avoid paying taxes on that? You see what I mean? As soon as you unwrap it, it's considered a swap. You're swapping your wrap memo for unwrapped memo. You could have swapped them for anything else like Bitcoin, Ethereum, Matic, whatever token you want, but when you unwrap, it's like a swap. And when you do a swap, we saw it earlier, that's a taxable event. And you have to pay taxes at that point. So if you want to take advantage of this, of the wrap memo, and not have to pay taxes, keep it wrapped. As soon as you unwrap it, it's a taxable event. As soon as you swap it for anything else, it's a taxable event. Okay? All right. So, hopefully we understand a little bit more about the wrap memo here. Now we use it as collateral, and we borrow MEMS if we're on Abracadabra. Okay? MEMS is a stable coin. And then we can use that stable coin to buy anything else. Okay? Now if we do all this properly, there are no taxable events happening here. Typically, if you swap MEM for something else, there would be a taxable event, but there's no gain here. Okay, so the taxable event is null. Okay, if you take a stable coin and you swap it for something else, your chances of making a profit during that transactions are next to zero. It's very, very small chance of making a profit because the stable coins don't vary much in value. Maybe they'll go up, less than 1% or something like that. So you might have a tiny bit of tax when you swap them, but it shouldn't happen much. Okay. All right. So that's for the review of this stuff. Now let's. We talked about wrapped yield-bearing assets, and some people asked me to make a list of them. So here's a list of those that we talked about in previous videos. Okay, we have the wrapped staked home from Olympus Dow. We have the wrap memo from Wonderland. This is a new one, the wrapped staked HEC from Hector Dow. They have their own wrapped stake token. Then we have the CAM series, so compound, AVI, market, wrap, matic, okay, and then the USDC, DAI, USDT, and so on versions of that. Okay, these come from my finance. Okay, and previous episode of Time to Be Your Own Bank, we talk about this. So for those that are not aware of that, have a look. The links are below. We have also the MU-AVI AVAX token. So basically you deposit on BFI and then you can take the token and borrow against it on my finance again. Same kind of story here, but this is on the Phantom network. So these are available on the Phantom network on my finance when you deposit these tokens on BFI. Okay, now be very careful because BFI has a zillion different tokens, but not all of them can be used to borrow against on my finance. Okay, only these. All right, so check in advance which token you're getting. Okay, because some people told me, oh, I deposited AVAX on BFI, but I cannot find the MU-AVI AVAX token. Well, they didn't deposit in the right vault, and they ended up with a different token. So that's what happened. All right, let's go to the next section. These are tax planning strategies relating to crypto. First one is probably the most important one. Don't sell if you don't have to sell, okay? Because this way you avoid generating a capital gain. I don't know why a lot of people just buy and want to sell. They just took a little bit of profit and so on. Look, unless you feel that the market's going to dump, okay, what's the reason for selling? Okay? Because, okay, it's nice to take your profit, but if you really don't need to sell, maybe you shouldn't. There are some assets that are worth holding for the long term, like Bitcoin, for instance. And I would argue also like wrap staked home, wrap memos, and those kinds of assets. Okay, some of those that we saw just earlier in the wrap series. I wouldn't sell those. I would keep them, and it would generate income and grow in value over time. Well, not generate income, but generate value, which is wrapped in the token so that it doesn't create a taxable event. So they keep growing and growing and growing and growing in value. Okay. So why sell them? They keep growing in value. Oh, there's no point. Okay. Now, I mean, there are the tokens, that are not generating value. So let's say, I don't know, you got a Shiba Inu token or the Doge token. They're not generating anything. So, buy and sell them if you have to. Okay, take your profit, but every time you take your profit, it's going to be a taxable event. Up to you. Use wrapped yield-bearing tokens to avoid generating income. We just saw that. Okay. Borrow against your yield-bearing assets instead of selling them to get cash flow. So that's what we talked about over here. Okay. Get cash flow, not income. Understand the difference between cash flow and income. Cash flow is not taxable. Income is taxable. Purposefully sell crypto at a loss to reduce taxes. Okay, so let's say you have a token, like you bought Ethereum, and you bought it at the top. And now the market crashed and you lost, I don't know, 50% of the value. And you happen to have a lot of taxes to pay on other capital gain that you created or other kinds of income. Okay, check with your accountant what you can deduct or not. But it might be a good idea to claim a loss here. If you can use that, check with your accountant. If you can use that to reduce your taxes, then that could be a good idea. So check with your accountant before you do anything silly. Okay, and you sell your Bitcoin, you have a big loss and you cannot use it because you didn't have enough capital gain to match against it or other kinds of taxable income. So make sure that it works with the laws, the tax laws of your country. So check with your accountant for that. Now here's a strategy that I thought was interesting. Somebody mentioned that in the comments of my videos yesterday. So the guy was suggesting that maybe we could purposefully borrow the maximum on Abracadabra against our crypto in order to get liquidated on purpose and incur a loss to reduce our taxes. Again, check with your accountant if it's a good idea or not. Okay? It might be a good idea in some cases. Let's say you have way too much capital gain or whatever. I'm not sure how it works for liquidation, if it's considered a capital loss or an income loss. Again, check with your accountant for the details. But, I mean, the strategy has some merit. I might not want to use it myself, okay? But the idea is that you're not losing a lot of money because let's say, for instance, you're depositing wMEMO on Abracadabra and you borrow the maximum. Right now, the maximum is up to 70%. So let's say you hold your wMEMO and you waited for a while and it grew and grew and grew and grew and grew. Okay, so you made a huge capital, unrealized capital gain, right? You borrow the maximum against it, and now you have a big pile of MEMS in your wallet. And you know that you have a large capital gain or large taxable income that you want to reduce. Okay, this might be possible to reduce your large capital gains or taxable income if you get liquidated. Maybe. So check with your experts, your tax experts and your accounting expert in your country to see if that would be a good strategy in your case. But don't do that if you don't have a huge capital gain to offset or a huge taxable income to offset. Okay? Don't do that just for the fun of it unless you really like to play with your money and risk it like that. But it might be an interesting strategy, but check with your accountant if it works for you. Okay. Next, these are for people that are a lot more involved and make huge profits with their crypto. This would be very, very complex, and you need experts to do this. Okay. So maybe you could create an offshore entity that holds your crypto. So if you're in the United States, maybe you fly to Panama or Cayman Islands or something, and you get a tax expert to work out something for you there. But that's not going to be cheap. They're going to charge you thousands of dollars to set that up. So again, this might work only if you've got like millions of dollars to play with here. Okay, so if you've got a $10,000 portfolio, yeah, forget about this. There are the other options could be interesting is move to a tax haven. Interestingly, in the United States, Puerto Rico, which is a U.S., it's almost a state. It's a territory that they have I believe they have a representative in in Congress, but they don't have senators yet, or something like that. And they have their own tax laws that are different from the rest of the United States. And from the articles that I read, well, apparently they have very, very small capital gains taxes, and they have all kinds of tax advantages relating to crypto. So if you're an American citizen and you're making a ton of money with your crypto, Puerto Rico might be an interesting choice for you. Now, there are a couple of disadvantages of living there. Hurricanes. They had a lot of hurricanes in the last few years. So make sure that your building is hurricane-proof. And apparently there are lots and lots of power outages, sometimes several per day. So anyway, nothing's perfect, but maybe it's an option for some people. We know also a little bit about Portugal, that apparently there are no crypto taxes because the government just doesn't bother with it. More countries, if you look here, they talk about 11 countries on Decrypt that don't tax Bitcoin gains. Sometimes it's just Bitcoin, sometimes it's crypto in general, whatever. So, I don't know if you want to go to Belarus, but apparently that's one place. Germany has an interesting tax treatment also. Depends how long you hold the crypto, apparently. Okay, and there's certain amounts that are not taxable, and over a certain amount taxable, whatever. Anyway, check with tax experts for this. Hong Kong as well. Okay, apparently there's some ways to not pay too much on crypto for this. El Salvador apparently says that Bitcoin, because it's considered a legal tender, there's no tax on that. But other crypto would probably be taxed. Malaysia also, they say they don't have capital gain tax on crypto because, they just don't think it's that kind of asset, whatever. But they might change their mind later. Who knows? Malta also is thinking that they're a blockchain island, so they're very pro-crypto, so it might be some advantages there. Portugal, we talked about that. Apparently, the sale of cryptocurrency by individuals, not companies, has been tax exempt since 2018, according to this. Normally, you would have to pay 28% tax, but apparently not if it's crypto. Then you have Singapore as well. There's no capital gains tax there, so whatever profit you make off the selling of crypto assets, you wouldn't have to pay taxes on that. As long as you're not doing this as a trader, a day trader, then it would become income. And you have Slovenia, again, there's no capital gains if you sell Bitcoin. And Switzerland, well, Switzerland, they don't, apparently they have a crypto valley there. And cryptocurrency profits made by a qualified individual through investing and trading are treated as tax-exempt capital gains. So maybe you want to check Switzerland. All right, and Bermuda apparently. So no, they don't impose income, capital gains, withholding, or other taxes on digital assets. So, and that's not too far from the United States. And apparently, if you like to play golf, they have great golf courses. Okay, so this is an overview of crypto tax planning. Okay, try to make the tax law work for you. Okay, and try to avoid taxable events whenever possible. Okay, if you do that, you can probably reduce your tax bill. All right. But again, check with your certified accountant and tax specialist in your country, because the rules change from country to country. As you can see here, there's several countries where there are either no taxes or the taxes are handled differently. All right. So I don't know how it works in your country. You have to figure it out with your certified tax advisors and accountants. All right. So that's it for this video. If you like this kind of stuff, please like and subscribe. Don't forget to ring the bell. Download the free book. It's free. You put your name, your email address, you hit submit, and then a big fat button says download the free book. And if you don't like free books, you can go to Amazon, give $5.99 to Jeff Bezos, and Jeff will send me a whole $1. Imagine. See you later.